Has the market bottomed, and will we now have a V-shape back to all-time highs? We're going to answer that in this video. We're going to be going over a lot of technicals today, so buckle up, guys. First and foremost, we have to go back to 3 weeks ago on this channel. 3 weeks ago on this channel, I posted this video saying markets just flashed a warning. Now, in that video, I talked a lot about the Williams percentage range and how we were breaking down out of the Williams consolidation box, one of my personal strategies that I created that has consistently shown that when we break down out of these boxes, we typically see a correction on the weekly chart. Now, 3 weeks ago, I posted this and I talked about this. Since then, we had an 11% correction on the NASDAQ 100 or the QQQs. 11 days ago, I posted a follow-up to that video talking about more warning signs that I was seeing in this market. And obviously, since then, we saw this correction. On X, just this beginning of this week, before all this craziness happened with hedge funds eating other hedge funds and the whole Leopold Aschenbrenner's whole fiasco, I said this, and this was at when NASDAQ was at $676.27. We were at the green barrier on the Williams percentage range, which green barrier shows that we are super oversold and that typically we get a bounce. And I said this, flush then bottom on QQQ within 2 weeks. Historically, when the Williams percentage range gets to the green barrier, we bottom within 2 weeks on the weekly charts. As long as this isn't a sort of a bear market, then level 1 bottom is 660, level 2 bottom is 630, giving you levels because no one truly knows. Williams percentage range doesn't close until end of the week. So this wasn't going to end, and we're going to talk about this in this video, doesn't end until the end of the week. Well, this was at the beginning of the week, and lo and behold, we hit 660 on the nose. 660 on the nose, and we ripped right off of it. We hit 660 on the nose, 11.65% correction on the QQQ, and then we absolutely ripped back up to 688 for a total of, off that, we ripped back up for about a 4.41% gain since we hit that 660. But the funny thing is, for the week, we're slightly up. Slightly up. I thought we were going to be slightly down. For the week, we are slightly... No, we are slightly down for the week. So this is what I want to talk to you about in this video today. I want to talk to you about a little bit of options market, what the option market and gamma charts are saying, what the Williams percentage range is saying, what the high 5 temperature down here is saying, and so on and so forth. We're gonna break all this down, guys. Let's break it down. Let's get down to the nitty-gritty of these technicals, and let's figure out where this market is going and what could happen in the different scenarios that I see playing out. So we're first going to talk about just the basics. We're going to talk about the basics of where this market is at right now. Where this market is at right now is that we came down below the 21 EMA and then we instantly snapped back up above the 21 EMA. That is actually pretty bullish. And again, on the Williams percentage range, we came down here to the green barrier. Green barrier, we do not stay here for long unless it's a bear market. We come down here and we typically see these large bounces and bottoms off the green barrier, again, unless it's a bear market. If it's a bear market, everything goes out the window. So we were down here about Wednesday with the massive sell-off, and then we snapped back huge, obviously Thursday and today, and now we are back up here to 69. But like a pendulum swinging side to side, we go between the green barrier and the red barrier, back to the green barrier, red barrier, green barrier, red barrier, so on and so forth. The pendulum swings back and forth and back and forth. And right now, the pendulum is still swinging down to the green barrier. Yes, we've had a bounce. Could this be bottom? It could. But right now, the momentum is still bearish. The momentum is still swinging down to the green barrier, and we have not hit that yet. So based on this, yes, we are back above the 21 EMA. That is bullish. But we have this large wick in all this area down here to basically eating wicks is what I call it. And we could basically come back down here next week and revisit this 660 level before maybe we print the green barrier bottom and then we continue higher on the weekly. Overall, if we look back in history, guys, if we look back in history, when we come down to these green barriers, not only are we coming down to the green barriers, but when we get these pullbacks, we are typically coming back down to where? This white line. What is the white line? The white line is the 50 EMA. 50 EMA, exponential moving average. We come down to the 50 EMA, or obviously below it with this one, we came down to the 200 daily or weekly moving average. Now, this was obviously a huge correction during Tariff-Geddon as we got down here to the 200 week moving average. That was an incredible buying opportunity, and we just waterfalled right down here and buying this level, obviously for a bear market or during this correction, was a really, really good spot to be adding. But typically on these corrections, we hit the 50 EMA and then we move higher. Well, again, we have this room down here to get to the green barrier. We have not gotten to the green barrier yet. We have not closed on the green barrier yet. So this leads me to believe that we could come down here to revisit 660, close on the green barrier, then move higher. Or we could come down here and revisit, flush down to 638, 640-ish, down here to get a 50 EMA touch like we had 1, 2, 3, 4 other times. 4 other times. There was only one time in here right here where we actually hit the 21 EMA and then bounced and went straight back higher with a green barrier touch. So more times than not, you get a 50 EMA retest when you get also the pendulum swinging down to the green barrier. Okay. So that is the first and foremost thing. And again, if this is a bear market, then everything goes out the window, because a bear market, you're just going to chop down here sideways, create a Williams consolidation bearish box, and then you're going to just continue to fall. Fall. But again, you'll be able to know this because you'll have something like this where you consolidate, you break down, retest the 50 EMA from underneath, then reject it, retest the 50 and the 21 EMA from underneath, reject it and fall again, and have a bearish cross of the 21 EMA falling down through the 50 EMA. And you're just going to consistently come back and retest this and continue to fall until you consolidate out, come back up, break above the 21 and the 50 EMA, retest it, get a bullish cross, and then we're up and away, retesting it along this bull market as we see, with some corrections coming down underneath it. I know I just said a lot, but that's how these EMAs and moving averages really work, guys. So again, the green barrier is very, very good. The Williams percentage range is very, very good outside of a bear market. At that time, you have to start using a little bit more wit and technical analysis to really understand what is going on. So again, could this be the bottom? It could. We've seen that before, like here. But again, that time we hit the 50 EMA. We've seen it when? Back here. Again, that was the end of the bear market. You see, we really haven't hit this bottom too many times. Right here, maybe. But again, you hit the 50 EMA. So you really don't know. You usually have to hit the green barrier and then be at the 21 EMA and then go to be good, to be Gucci, to get out of this correction. Typically, you're getting down to the green barrier and the 50 EMA before you get the bottom. So that is what I'm looking at right now. And I'm leaning towards we'll revisit 660, or we'll come down to the 50 EMA before we actually bottom. And that's also as long as this is not a bear market. Because we are seeing bonds climb higher. We're seeing bonds break out, yields break out. We're seeing a lot of negativity around that. And the Iran stuff is still going on, and there still could be oil shocks around that. Oil's breaking higher. If we pull this up real quick to kind of divert into some economics and macro conditions, we can see that the VIX is still pretty low down here, honestly, but that just means it's low down here, it's coiled up, and it could explode higher like we saw here, here, and here, right? So this thing is still low and the market's been going down. That's not the greatest. That means if we really do get a big pop on the VIX, then the market could really get crushed down. If we look at oil, had this big run up. Now this collapsed down, but it's starting to hold these EMAs again and starting to trend back up. Already hit the green barrier right? And guess what? It's starting to pendulum swing towards the red barrier. So if you look at this and you say, okay, we're at the green barrier, then we swung up to the red barrier. We're at the red barrier, then we swung down to the green barrier. Now we're at the green barrier. What do you think we're doing? We're swinging up to the red barrier. Not too many times we just get here and then fall right back down. Sometimes, but typically, guys, we swing from one end of the pendulum to the other, guys. One end of the pendulum to the other. So you have to sit there and say, the momentum is carrying oil higher. So this is saying that we probably are looking to get back up here between 108 and 116, and that is bearish for markets. And there's no end in sight. And obviously that causes more inflation, possible rate hikes. It caused a lot of bugaboo, caused a lot of crap, honestly. And then we go down to the yields. The 2-year yield is in an uptrend. The 10-year yield is almost breaking out here. It's almost breaking out. If it breaks out up here and then goes to 5% plus, big trouble. The 20-year is breaking out of this previous high. Next is up here at about 5.4%. Guys, as these yields go higher, what happens? People sell their stocks and then start buying these yields. They start buying these bonds. Because what? Because why? Because if they can get 5, 5.2, 5.4, 5.6, 6%, 7%, if they can get that guaranteed money with their money, if they can get that guaranteed return on their money, 5 to 6 to 7%, they rather do that than try to invest in stocks. So you see this mass liquidation of stocks, which brings down prices, which causes things to fall heavily. And a large portion of money moves into money markets because yields are safer. They're basically guaranteed, to return you that 5.3, 5.5, 6%, right? And when that happens, you're getting a great deal. And that's why you see people liquidate stocks and then they just go into yields because it's considered easy money at that point. So So this also all makes me lean more towards, I don't think the correction's over just yet. Unless this gets rejected right here and we start seeing this thing trend back down to sub 5%, then things are very dicey. We need oil to crush back down. We need these yields to crush back down. If they don't, then things could get really dicey and we could be in for a bear market. It is not off the table that this could be the beginning of a bear market, okay? It is not off the table. If yields keep climbing, oil keeps spiking, the Iran thing lasts longer, and countries start running out of oil, things can get very, very crazy. And the VIX is all the way down here, you could see a large pop, a very large pop, ladies and gentlemen. So I lean more bearish right now. I truly do. Until we see the things that I'm talking to you about start playing out and showing us that, hey, things are actually not as bad. And now here is the Williams percentage range. Here's the Williams consolidation box that I told you about. Once we broke down below that 9 EMA on the Williams percentage range and we broke out of this box, I said, rut-row, things are not looking good. And like I said, we did get that correction so far. And now we came down having a snapback. But again, we can revisit this area down here because we are trending lower. The momentum is pushing down to the green barrier. And you see it time and time again. When these break, these fall and we get corrections. They break, Williams consolidation box, bullish, bullish, bullish. They break, we fall, correction. They break, we fall, correction. They break. This one get a fake out and then it fell big, 25%. This one was here. Broke down, did a fake out, then we fell, right? All that chop, and then we fell 12.62% beginning of this year. This one, a little bit of chop, right? After a huge spike up and then a huge move down. And again, we still have room down here to the bottom. Another indicator that I have is the temperature. The temperature is very simple. When we're above this zero line, things are bullish. When we're below this zero line, things are bearish. We are in correction mode. Mind you, we just flipped. We have already been down 11.65%, and now we sit 8% off the highs on the Qs. And guess what? We just flipped on the temperature. Now, could this all happen and then it already be bottom? Sure. But typically, When we flip, we sit down here for a little bit and we either chop or we have a correction. Here, we had a big correction. Here, we had a correction. Here, we had a correction, and then we bounced back. So this time right here would have been that, okay, we just started here like we did here, and then we had to move back up pretty quickly. So that could definitely happen, but more times than not, when you break this zero line and you go down here, it is very bearish. It is very bearish, and this is the weekly time frame. This is not the daily time frame. So this is higher time frame and bigger structure building out. So things just don't look the greatest right now. And until we start seeing this flip to like yellow, orange, green, yeah, it's not looking good. And then your bull trend, your leading trend line on the bull and bear trend is flipping to red. It's about to cross here. And if it crosses, then we then have a bear trend, right? We get red across the board. We then have a bear trend. And then obviously that'll continue to reject us on the way down. So yeah, the temperature doesn't look good. The Williams percentage range doesn't look good. The only thing that really looks good, honestly, is the fact that we wicked back above the 21 EMA. We reclaimed the 21 EMA. But if we just give that back next week, that's not looking good. So yeah, it's still ugly out there. It's not kumbaya. Things are okay. Like, it's still ugly out there. In the gamma markets, the option markets, if you come on over here to Voltic.io, you get 20% off access to Voltic.io, get all your levels, get all your options flow, tons of different tools all in this app. I really enjoy using this app to understand the put walls, call walls, levels, where stock's going to get hung up, and where the volts are. The volts are your magnet that show you kind of where the options market thinks that the price will go. And it kind of does work like a magnet, and it pulls it in that direction. So this is the next 3 months. We got August and September. Historically, based on seasonality, August and September are the worst months of the year. That's historically based off seasonality since like 1990s. So historically, based on seasonality, not looking good for August and September, which also July is usually a bullish month, but it was a bearish month this month. So you got to take that into consideration as well. But overall, guys, it's saying that next week, we are going to see, more chop, 685, 694, 700, 695 on the Qs. But then it's saying 660. The node is down here at 660, and we're currently at 689. So it's saying that a large portion of the options market is going to be pulling price down to 660. Again, guys, we are currently at 689. 660 was back down here towards this low. So when I talked about eating the wick, eating the wick, if that happens, then we're going to come back down here to 660. And then obviously the options market could change and things could get worse. And then they could chase this down lower and then start doing like 640, 650s, 630s, right? To chase down to the 50 EMA. So this is going to change every single day, every single week. But right now it's showing that chop. Things are okay, a little bullish. Maybe we get back to 700, but then it's saying it's going to rug pull right back down to 660. The week after that, the second week of August, we got nodes down to 685, up to 710, 685, 680. So basically, reading this, it's kind of saying that we might have one more flush down to 660. And then after that, we chop and then move back higher to like 705, 710. And that makes a lot of sense to me. You know why? Because what were we just talking about at the beginning of this video? We were talking about how a move back down here to 660 would get this Williams percentage range to close down here at the green barrier. If you close down here at the green barrier, down in this range, I'm going to buy options a couple weeks out because the green barrier has held and bounced 1, 2, 3, 4, 5, 6 times. The last 6 times it's bounced and sent us higher the next couple weeks, except for a bear market. So I'm okay taking options and taking a bet, saying that this is going to be 7 of 7 times that we have a big bounce and I make good money. off these calls for the next couple weeks instead of a potential bear market. If it's a bear market, then I lose, and that's okay, because I rather take the 6 of 6 times and go for 7 of 7 rather than saying this is going to be the 1 of 7 times that this is a bear market, right? So that's what I'm looking at. So it does make a lot of sense. Maybe revisit 660 next week, have this pull down to the green barrier, hold there for that week, and then we continue to climb higher in this bull market. And part of that could be a flush down to the 50 EMA. Like I said, that typically happens with this market. So we'll just have to see. That's what the options market are saying. That's what the Williams percentage range is saying. That's what I'm seeing. That's my technical analysis. If you guys want to get access to the trading collective for July, it was a very tough month in July. I don't think I have to tell any of you traders how tough of a month it was in July and June. It was two very tough months to trade, but we did squeak out a 3.82% increase in our trading portfolio for the entire month. Now that wasn't green, okay? In the main trading account, which is our long-term trading account, we did 1.62% negative. And then of our options trading small account, we did 5.45% gain in the overall account. So overall, that brought us to a net gain in July of 3.82%. And for year to date so far, we're up 68%. I tell everybody in my community this. I say this very clear and simple. We are in a very tough time. The charts are not saying higher, higher, higher. The charts are saying potentially lower, 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 or chop, chop, chop. And when that environment happens, that is the storm. I call it storm climate. That's where we need to be trading less than 30 to 40% of our trading portfolios. And we already made 68% gain on our trading portfolio this year. Massive gains as the normal S&P 500 returns 8 to 10% average per year on a compound annual growth rate. 68% gain in our trading portfolio. I'm not looking to trade during the hardest times right now and go crazy with my trades. I rather play with a little bit of money and win based on the strategies. But if I lose, because it's very difficult times, it's okay. And that's what we've been doing. I'm not looking to give back my 68%. Too many people do that. They win for 3 months and then they sit there and they understand that the market's getting extremely difficult to trade in, but they still try to act like a genius, not in a bull market. And then they get decimated. And then this 68% return either goes to zero, break even, they didn't make any money for the year, or worse, they go negative on the year. And then they're like, oh, why did I trade during this time? That was so dumb. Be a genius in a bull market. Don't be a genius when it's the toughest trading environment for the entire year. It's very simple. People just have this need to constantly trade. Nah, that's not me. That's not what we teach over here in the trading collective. We teach a simple process. Let's be bulls let's be geniuses and bulls in the bull market, and let's be geniuses by not playing with fire whenever it gets hard during bear markets, corrections, and when things get really difficult, like it's been in June and July. Chop and then a giant correction in the overall QQQ. It's not been easy, but we were able to squeak out a bullish month, a positive month, and overall, we're sitting pretty, 68%. If I ended the year tomorrow at 68% gain, I'll pat myself on the back, tell my wife how great I did this year, and I'll take her out to a nice steak dinner. That's it. That's it. That's the game. Stop trying to get rich tomorrow. Stop trying to make $1 million a day. What are we doing? What are we doing? Be smart. Have good risk management. That's what we do here. That's what we do in the trading collective. We're not a bunch of idiots just sitting here gambling. That's not that. If you want to go gamble, go somewhere else. I don't know. Play ODTEs for random reasons, like not having a strategy, not having a framework. Like that's not how you become a profitable trader. That's not how I was able to leave the Air Force. Okay, that's not how I was able to leave the Air Force and forget about a 20-year retirement that I was already halfway towards, and come out and become a full-time trader to support my family and work for me. Okay. So you do it by good risk management, not by gambling and being an idiot. Okay. So, yep, that's my spiel. Come join the trading collective if you want. I'll leave that link down in the bio below. If you want 20% off Voltic, leave that link down in the bio below, or any other deals or partnerships that we're running. currently running another deal in partnership with Options Funding. If you want a funded account, fully funded account where you keep 80% of what you make running options, you can do that. I'll leave that link down in the bio below. I think right now, until market close, it's an 80% discount. If you miss that one, there'll still be a solid discount on the page in the link below. So appreciate you guys. Hope you got value out of this video. And yeah, have a great weekend. I'll catch you guys next week.